Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Colin Stewart, CEO and Portfolio Manager at JC Clark, will be joining us for the hour. Then, in 30 minutes, James Slifers, CEO and co-founder of Skywatch, will be here to tell us about how his company is using AI to transform satellite imagery. And of course, we want to hear from you this morning on First Call. Reach out with your questions on North American stocks, and we'll have Colin answer as many of them as he can. That'll be at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. OpenAI plans to discontinue its Sora AI video generator. The AI company is also winding down its partnership with Disney, which was centered on the app. Disney had previously agreed to license its iconic characters to OpenAI for use on Sora and to take a $1 billion U.S. stake in the startup. The move to shutter Sora coincides with a push by OpenAI to streamline its product lineup. Chorus Entertainment has received a court order to proceed with its previously announced recapitalization transaction. The plan is designed to strengthen the entertainment company's financial foundation and support its long-term business strategy. It includes reducing debt and other liabilities, decreasing annual cash interest payments, and maintaining access to its credit facility. GameStop recorded lower revenue and profit for the fourth quarter sales of hardware, accessories, and software. The American company's stockpile of cryptocurrency also declined in value. On the upside, revenue from collectibles rose 35% from the year before. In January, the GameStop said it was planning a major acquisition of a public company to increase its value. And now our top line story. Oil falling as a diplomatic push by the U.S. to try and end the war with Iran gathers pace, eclipsing news of more troops being sent to the region and the Strait of Hormuz remaining largely shut. For more on the latest market impacts, let's bring in our guest for the hour, Colin Stewart, CEO and Portfolio Manager at JC Clark. Colin, thanks as always for joining us.
Good to be here, Roger.
And we'll start with where oil is now. By the end of the show, we'll have probably a completely different conversation. It is, I think volatile is an accurate description today, or for the last little while.
Yeah, I mean, it's a very challenging environment for investors. Things change on a dime. And as we know, I mean, it's the market is really hanging on Trump's every word. And as we talked about earlier, he is extremely unpredictable and seems to change his mind day by day, over the weekend, minute by minute. I mean, on one hand, he's seemingly sending Marines and troops to the Middle East, and at the same time, talking about a diplomatic solution. I mean, our view generally is that he does want an off-ramp. I mean, we have to remember how sensitive Trump is to, the stock market and doesn't like the stock market going down, B, his ratings, which I don't think the American people generally like this war. And obviously high oil prices, which hurt the consumer at the gas pump. So I think those three things really, lead us and other investors to believe he does want an off-ramp. And the question is, how easy is that going to be? And I think, there was a reason he came out pre-market Monday morning with that comment that, sort of looking for a diplomatic solution and backing off here, giving Iran more time. So the question is, how easy will that be? I think Iran knows maybe they now have some leverage over Trump because he wants an out here. And we'll have to see how that plays out. But obviously some optimism this morning, as you suggest, with oil prices weakened and futures up on sort of hopes that there may be a diplomatic solution in the offing here.
And from the political, I guess the big question is, who is he actually negotiating with in Iran? It's still not entirely clear who may be in charge there. Are you surprised at how the markets are reacting this week? Like we're looking at maybe a third day of up. Are they looking for anything right now? Is that what it is?
Yeah, it feels like that. I mean, I don't think, the one thing that still concerns, a few things still concern us. Overall, we've been fairly cautious, and I think we still are, albeit I do feel like if this Iran conflict comes to an end or there's some diplomatic solution, we likely will have at least a short-term rally here in the markets. But I mean, we have to remember there's still issues. We still have potential inflation risks. Employment market has been weakening in North America. We've got this AI disruption risk. I think private credit markets are unwinding to a degree. So there's a number of factors that are still, I think, concerning. And to your point, I mean, we really haven't seen often in these situations like we did a year ago in March and April, we saw a real capitulation. The S&P 500 a year ago was, down 20% in March, early April when it corrected. And this time, sort of peak to trough, we've seen about a 7-8% pullback in the S&P 500. But I don't think we've really seen that panic and investor capitulation, which, gives us some pause. And I would say we're not, planning on getting too bullish here. Investors have to be nimble, but overall, there's still, even if we do come to a solution with this Iran conflict, I think there's still some issues for investors to be concerned about.
Yeah, I was looking, the TSX, I think, is right around where it was at the start of the year. So it's kind of a wash right now.
Yeah.
One of the things I was like, I mean, gold and silver, everybody thought it would shoot up. It's not. People have sold to get some cash ready. Copper, though, I was looking at copper, and it seems to be running on its own little course. It's down. It's almost down to last year's lows. Not quite, but it's been dropping quite a bit over the last little while. Where is that playing in with everything else that's unfolding?
I mean, I think it's really, there's this fear now in the market of just economic weakness. There have been some signs of it, and if we get sort of, a lot of people have been using the word, which the markets really hate, stagflation, the idea that we're going to get a slowdown in economic growth at the same time as inflation. We have seen, I think the PCE reading in the US last week was higher than expected, which is a negative, might lead to fewer rate cuts in the near term. And anytime you have war and conflict, there's obviously risk of sort of that being inflationary. So the idea that you have inflationary risks and with high oil prices, potentially attacks on the consumer, maybe weaker economic data coming through. So that mix is really not one that the market likes. And I think that's one of the reasons that we may be seeing weakness in copper. I mean, they always say copper is a really, tied very much in with the economic cycle and GDP growth expectations. And I would say right now, people are a little bit worried about with the high oil prices and the conflict in Iran of just having some broader economic weakness here.
All right, we're going to take a break there, but lots more to talk about. Up next, though, we'll take a look at the markets before the bell. See how things are shaping up on the markets right now. We'll start with the U.S. futures and green across the board there, reacting obviously to the news that a possible peace plan has been put forward, or at least maybe a ceasefire plan. It's been apparently rejected by some Iranian officials, but right now they're willing to take it. And you can see the Dow's up 1.1, NASDAQ by about 1.25, and the S&P 500 by a little more than 1 as well. Heading to Asia, and they were still playing a little bit of catch-up from what unfolded on Monday. They're up again, the Nikkei by nearly 3%, Hang Seng by more than a point, and the CSI 300 by 1.4%. In Europe, financials and large caps leading the way, a second day of solid gains there as well. And you can see the FTSE up by 1.33, CAC 40 by 1.55, and the German DAX up by 1.6. And the TSX yesterday just squeaked out positive day, up by 0.18%. Commodity and resource shares helped it stay in the green, and it's looking at 32,000 again as we head into Wednesday. Some of the winners and losers from yesterday. Methanex up by 9.25, Boralex by 7.5, Dollarama going the other way on its earnings, down 9.6. MDA Space also off by nearly 10. Heading to the metals, and look at gold right now. It's after bouncing down, dropping 20%, and it's now up 4% today to 4,600, above 4,600. Silver also up 5.3, back above 73, and copper is rebounding nicely as well. It's up by 1.76%. Western Canadian Select spread tightening slightly. Yesterday it closed up 4.5%. And WTI for today, where are we sitting at right now? Yeah, responding to everything unfolding in the Middle East, it's off by 5.6%, down to $87 a barrel. Colin Stewart is with us for the hour. He's the CEO and portfolio manager at JC Clark. And Colin, you're bearish, but make sure I say the right word, not bullish, bearish about private markets. What has you worried?
Yeah, I mean, I think we're now...
What doesn't have you worried?
Well, we're seeing an unraveling sort of, I think, in the private asset space as we speak. And I mean, this has been an asset class or category that's been very, very popular with investors for the last decade. And, in some cases for good reason. I think the returns of some of these private real estate, private equity, private credit funds have been quite strong. There's also been a secondary, though, view that they're less volatile and safer than public markets, which I think is now being proven to be incorrect. And so, we've seen this before, as we talked about earlier, Roger, like anytime you have a lot of investor capital flow into a particular category or asset class, returns usually get compressed. And we've had, a lot of investor capital flow in. Those investment managers are forced to put that money to work. They're probably chasing lesser and lesser opportunities, paying more premium valuations, competing for return, and that dwindles down the return. And I think it creates risk because the 20th deal done is never as good as the first or second deal. So I think that's what we're seeing. And the other issue is that these have sort of had this safe haven reputation among investors in Canada and the U.S. that they think, well, these funds are very stable, they don't go down, but that really is more to do with the pricing mechanism and how those funds are valued. In other words, in public equity strategies, like we run at JC Clark, you see the pricing every single day. The stocks go up and down, and the price is what the price is, the NAV is struck. Whereas private funds, they're valued perhaps once a month, once a year, and there's a lot of subjectivity and discretion because we don't really know what those asset prices are.
Is there any regulatory on that? Like, do they have to?
Yeah, I mean, there are rules. Obviously, those funds are audited. The auditors have a process they follow. But I mean, inherently, if something isn't publicly traded, there's maybe a discounted cash flow analysis done. But that you can do a discounted cash flow analysis on a company in the public market, and it says it's worth 20, and it's trading at 12. So. The transparency of the daily public market pricing is something that has been lacking in those private funds. So there are really two issues now. Is we've seen a lot of these funds gate or freeze redemptions, and so that's been I think a shock to some investors who perhaps got into these funds and didn't realize that they could be gated. In other words, they can't now redeem and get their money back. And then we're seeing that happen in the U.S. I think just yesterday, Apollo announced that they were gating redemptions or limiting redemptions on one of their funds. We've seen BlackRock do it. A lot of these large U.S. Private equity firms are doing this, and it's causing a bit of a panic among investors. And then there's the secondary question of if an investor's most recent statement says their investment the NAV on the fund is $100, well, is it really $100? And can we trust those NAVs? And we've seen a few instances where one day the private equity fund or the private credit fund says NAV's 100, and the next day they say it's 80. So there's been a huge markdown. So the question is, are the underlying assets actually worth what they're valued at in the investor statements? And so, we'll see how that plays out, but I think it's a real risk for investors here.
What led to this initially, this recent surge of going this way?
Sorry, you mean the popularity?
Popularity, yeah.
Yeah, I mean, I think it was a sort of democratization play. In other words, private assets 10 or 15 years ago were, only super high net worth investors or pension funds could get into them, but a lot of funds started and provided more access to retail investors, and the average investor was able to access these strategies and thought, well, this is a great opportunity and I can get in, and perhaps they didn't really understand what they were getting into. And you can't paint the whole sector with one brush. I mean, there are obviously some very well-run private credit, private real estate, private equity funds, but I just think there's been such a rush of capital. Anytime we see that, everyone thinks, well, all these funds are great, and they don't really understand what they're getting into. It's more difficult because these funds are less transparent, more opaque, hard to understand what they're buying, what those underlying assets are worth, how to value them, what the terms of the fund are. Can I get in and out day to day? And in many cases, there's been the ability of investors to get in and out on a regular basis, but the underlying assets, there's been this sort of duration mismatch where the underlying assets in a private equity fund are typically have a a life cycle of 7, 8, 9 years. So if you're invested in assets that have 7, 8, 9 year life cycles and the fund can't get out of them, but you let your investors come in and out every day, there's a real mismatch. And now because people are worried, they're heading for the exits, and the funds are forced to sort of put up these gates to protect the fund, really. And I guess, we're really going to have to see how this plays out.
And there's really no recourse, is there?
No, I mean, those are the terms. Each of these funds has different terms, but they're written into the offering memorandum or prospectus of the strategy. And the investors are, the fund has the ability to do this. And I think now some funds are even trying to strengthen those protections and allow more gating. And perhaps it's a good idea to protect the investors and not have a quote unquote run on the bank. But, I think ultimately, in our view, this is going to lead to, when those gates come down, a lot of redemptions in private funds and some of that money flowing back into public equity markets in Canada, which we think will be a good thing for public equities and public equity managers in the Canadian market.
All right, we have to take a break there, but we'll be back with Colin Stewart, CEO and Portfolio Manager at JC Clark, to see why Magellan Aerospace is on his radar. Time to see what's on the radar for Colin Stewart, CEO and Portfolio Manager at JC Clark. And Colin, a few picks in the aerospace sector, including Magellan.
Yeah, Magellan's a Canadian aerospace and defense company. They effectively are a supplier to some of the very largest aerospace companies globally, like a Boeing or an Airbus. And they have about 60% of their business where they do parts and supply structure parts for the structure of an airline or airplanes, parts for structures of engines, and they supply about 60% of that to commercial aerospace companies, and about 40% is defense military. So we think that's a nice split in the outlook for both those sectors. Obviously, there's continued growth in air travel globally, so that's really benefiting the commercial side. And then, as we know, there's been a huge, sort of push, Canada, Europe, NATO countries to increase defense spending because of this idea that we can no longer rely on the protection sort of blanket from the US. And that has created a real push from NATO countries. And even here, we've seen recently a lot of announcements from the Canadian government. They're going to spend, I think, $81 billion over the next 5 years on increase in defense spending. The idea in Canada, we're going to try to get that NATO target up from 2% of GDP to 5% of GDP on defense spending. And all these trends are very good for the demand outlook for a company like Magellan. It's not that well known a business, so it trades at a lower multiple than some of the other aerospace and defense companies, only trades at about 8 times forward EBITDA, has a very strong balance sheet, so we think they're in a position where they might be able to make some acquisitions and use their balance sheet for that. And like many other aerospace companies, they ran into some margin cost pressures during COVID, and with labor and supply costs going up, and they've now worked through those. So we're starting to see margins in that business really improve, and we think there's more upside. So even though the stock's had a good move here, we still really like it.
All right, got a couple others I want to get to. Standard Aero. Yeah,
Standard Aero is a U.S. Traded company. They're basically the largest player in the aerospace engine maintenance repair globally, and so it's a company that is really benefiting from the commercial side or the commercial aerospace cycle. They've got some business with private jets and maintaining engines for those, and the military as well, but it's more of the business is on the commercial side. And we've got a situation now where there's a shortage of engine manufacturing globally for airplanes. So that means the engines that are currently in planes have to work harder and last longer, and that requires more maintenance. So because of that, Standard Aero's business has been growing nicely. They were actually owned by private equity and just got spun out publicly in the last year or so. Again, it's pulled back recently because of this sort of market pullback, trades at about 10 times EBITDA, so we think the valuation's reasonable. And then they also have a lot of longer-term contracts with their customers. So about 75 to 80% of their business is through long-term contracts. So there's a fairly high level of predictability to the revenue stream, which we like as well. And I just think that, more people fly, there's a shortage of engines. The current airplanes, there's every so many hours those engines need to be overhauled, and Standard Aero's, the leader in that business. So we think the outlook over the next decade is going to be really good for that company.
And no concerns from the defense side that maybe a new government changes, things go in a different direction. And with the airlines, I mean, it's always been a...
It's for sure up and down, which is why we like Magellan, they have a good mix. They've got, a focus on the commercial side with, customers like Boeing and Airbus and the airlines, but they also have a military component. As I talked about earlier, there's a huge push on military spending. So we're going to see more and more military aircraft, and those engines are going to need maintained over time. And then there's obviously been quite a boom over the last decade in private jets, and those also are going to need maintenance on their engines. So we just think the overall outlook for the sector, even though as you point out, there is some volatility, and air travel can go down in recessions. But I think if you think about it on a 5 or 10 year basis, that the secular trend are more people are flying, there's more defense spending. A lot of these engines are aged. The current fleet of engines is quite old, and there's a sort of a lack of new engine manufacturing. So the current planes that are in circulation need maintenance, and Standard Aero is going to benefit from that.
All right, let's sneak in the last one. Thomson Reuters, they've been beat up lately.
Yeah, again, this is a software business. I think it's one of the sort of real blue chip companies in Canada. The share price is down 60%, which we just think is totally overdone. I think it's a very high quality company. They're sort of a leader in software for tax, accounting, legal applications. They've got a very diversified customer base. About 80% of the revenue is recurring. So a lot of things to like. And the company ironically came out a few months ago and gave guidance for 2026 results, and they upped that guidance and said things are looking really good. We're going to grow faster than we thought. Our margins are going up. We're going to generate a lot of free cash flow this year. And despite that, because of all this concern of AI disruption, the stock has been, as I said, in the last 9 or 12 months, has been down 60%. So it hasn't been an issue of earnings declining. Earnings, if anything, are going up. It's really just been the valuation multiple is compressed and is now trading at 12, 13 times EBITDA, which is pretty unheard of for this business.
Okay, we got to head to a break now, but lots coming up. We're going to be talking to James Sleafers, CEO of Skywatch, on space-based imagery after the break. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Meta Platforms has been found liable for violating 2 state consumer protection laws in New Mexico. The tech company owes $375 million in civil penalties after a jury found Meta misled teenagers about the safety of its social networks. The trial is the first to reach a verdict among a wave of litigation targeting Meta and other social media companies, including TikTok and YouTube, over harms to teenage users. Shares of ARM Holdings are soaring in the pre-market, up more than 12%. The semiconductor company says it will sell its own chips for the first time. The move is forecasted to generate about $15 billion US annually within 5 years. Meta will be the first major customer for the UK-based company. Until now, ARM's main business has been to license its technology to semiconductor makers. OpenAI is going to discontinue Sora AI video generator. The AI company is also winding down its partnership with Disney, which was centered on the app. Disney had agreed to license its iconic characters to OpenAI for use on Sora and to take a $1 billion stake in the startup. The move to shutter Sora coincides with a push by OpenAI to streamline its product lineup. And taking a look at the markets right now in the U.S., they've calmed down a little bit. They're all up over a percent about 10 minutes ago, 15 minutes ago, and now they're still up in the green right now, but by 0.64 for the Dow, NASDAQ 0.76, and the S&P 500 0.59. All of this, of course, on reports there may be a U.S. offer for a potential peace plan, or at least talks with Iran. Satellite data is growing in prominence with the use of AI. From tracking wildfires to predicting crop yield, satellite imagery is reshaping how we understand the world. Joining us now to discuss how AI is transforming satellite imagery is James Sleafers, CEO of Skywatch. James, thanks very much for joining us today. We appreciate it. I'm going to turn and get a little more comfortable here. Thanks for joining us. Talk to us a little bit about what exactly Skywatch is. It sounds ominous, but it's not.
Very simply, it is a platform that allows our customers, the largest customer base in the world, to access imagery from about more than 90% of every imaging satellite that we have in orbit today. So there are close to 1,000 imaging satellites across a few dozen companies, satellite operators. We abstract all that, we integrate with all of them, and our customers, through a very single endpoint, can access data from all of those satellites. So they are in industries like mining, oil and gas, insurance industry. The very simple value proposition is if you need information about some location on the planet, our job is to use satellites to get that information for you.
All right, just out of curiosity, the other 10%, is that defense? Are those defense satellites?
China.
China, okay. You even have access to defense satellites to a degree, their imagery?
So no, all commercial imaging satellites,
okay.
which does represent a vast majority of the satellites. And that's what's unique about the world we live in today. 10 years ago, government had a monopoly on space-based imaging and capabilities. It's dynamic. It's shifted inversely. Now, commercial makes up about 90% of imaging satellites in space today.
Colin.
And James, how do you get access to that data? I mean, I assume you must have commercial relationships with those satellite companies. And is it getting, because of the increase in demand for this data, is it getting more costly to purchase that satellite imagery from those companies and aggregate it?
Exactly. So 10 years ago, government was also the only customer of any commercial imagery provider, that or like the large base map providers like Google, anyone who was doing large mapping projects. We came to the operators in the early days and thought we could really open this up to other commercial markets. They wanted to focus on customers that were really large in value, $500,000 to $1 million. But for us, like the comparison is GPS. Right? GPS was limited to a very small number of companies, was limited to the government until they decided to open up about 20 years ago. And today it is approaching $100 billion a year market that powers trillions of dollars in products and services. Our job was to convert a technology in imaging that few people had access to and enable more and more companies to build technologies integrated in their workflows and eventually make this as powerful and as much of an economic driver as what we've seen in GPS, and then what we're seeing in communications today with the growth of Starlink.
And with AI, I mean, this is the big, everybody's AI, but this must be a game changer for you. What's it doing for you?
So one of the reasons that commercial imaging had a challenge with scaling, it's funny when you think about it, you're kind of naive to it, but the biggest challenge with satellite imaging is clouds.
Mm-hmm. Well, it makes sense.
The world is covered by clouds 70% of the time. And so usually a human would look at an image before it went out to a customer. They would have to view it. And so one of the more powerful capabilities that AI has given us is the ability to automate cloud detection. Decide if an image is covering the area of interest that a customer needs to see, so can we send it to that customer or do we dispose of it? That's a big one. On the actual demand front, many business use cases that exist require geospatial information or geospatial data, imagery to solve, but it's not obvious to the end user. The ordering, the procurement of data has been limited to a very small number of geospatial experts inside of large Fortune 500, Fortune 5,000, 1,000 companies for as long as I can remember. We just launched the first satellite imagery app for ChatGPT last week. Mm-hmm. So now we're allowing organizations, people who have no expertise in imagery at all, with the ability to use an LLM to say, hey, I have this problem. How can I use imagery to solve it? And the LLM simply will determine what imagery is a best fit for what you need and then place the order with Skywatch. And then what we do is we look at all of the hundreds of satellites that we have access to. We figure out what satellite is best suited for that specific use case, the type of imagery that customer needs, and where they need imagery of.
Is this closing us in on like real time? Are we close to real time for like an average person or an average company almost?
The biggest bottleneck has been downlinking. So historically, when you capture the image, let's just say of my mug here, you capture an image, you then have to wait to go over a ground station to downlink that data. Now what's happening, you're seeing it happen here in Canada with companies like Kepler and Telesat, and you've seen it happen successfully in the US with Starlink, is we're investing in building intersatellite links. So you essentially have an internet in space where now that satellite takes an image of its location and through intersatellite links, whether it's optical or RF, can immediately start to offload that imagery through a network down to the ground. So within a few years, I should say probably by the end of this year, we're going to start to do real-time imaging where I can come on a set like this and I can say, where in the world do you want to see an image of? And before this interview is done, we're going to have a live image of that area.
Wow.
And I know there's been a lot of push about, in Canada in particular, about Arctic sovereignty and monitoring the Arctic, and I guess that's more of a government application, but are there any opportunities for your business to get involved with governments around the world who want more imagery of their own sovereign nation or Arctic monitoring here in Canada or things like that?
Massive. So I think what you're seeing right now is a realization that we cannot continue to depend externally for our intelligence, for our national security. And so there's a commitment through the Defense Industrial Strategy to ensure that we have a sovereign capability, I think, end to end. You've seen recent investments in space launch, and that's going to go all the way to the exploitation. So investment in space launch, investment in satellites, and then investment in the exploitation that we're capturing from those satellites. We have two roles. One is to monitor our Arctic, monitor our borders. But as I mentioned at the beginning of this interview, there are hundreds of satellites that are in the commercial market. Our job is to augment the Canadian Armed Forces' current capabilities with all those commercial satellites, enabling them to extend their monitoring network. So they use those commercial satellites for unclassified imaging capabilities that then better point their own sovereign satellites. So we act as an extension to their ISR, their intelligence, surveillance, and reconnaissance capabilities.
All right, we have to wrap it up there, James, but thanks very much. And we'll have you back when you can show us a live shot, all right?
You bet, yeah.
Cheers, James. Thanks very much for joining us. That was James Sleaford, the CEO of Skywatch. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Colin Stewart, CEO and Portfolio Manager at JC Clark, is taking your questions. You can reach us at 1-855-326-6266. Email us, first call, bellmedia.ca. Brookfield Asset Management and Caisse de dépôt et placement de Québec have agreed to a deal to acquire Canadian renewable energy firm Boralex for $9 billion, including debt. The buyers will pay $37.25 in cash for Boralex, according to a statement released today that confirmed a Bloomberg News report that the company was considering a sale. Shares in Boralex closed at 33 in Toronto on Tuesday, giving the company a market value of about $3.4 billion. La Caisse is already Boralex's largest shareholder with about a 15% stake. BNN Bloomberg will continue to bring you coverage of this story throughout the day. Okay, and let's look at some other early movers. I'm choked up by that last story. They were joined now by Bloomberg's Divya Balji, managing editor for the Breaking News Americas. And Divya, thanks as always for joining us. Temu's owner, PDD, their earnings out.
Yeah, and really disappointing earnings. I think it was an 11% drop in quarterly profit. It came in about 16% below the average analyst estimate. The company also said that it will be investing more in logistics and spending more money there, which is not something, the market really wanted to hear at a time where their profits are not up to par, I guess you would say. This is a company that is, competing with Alibaba and JD.com, giants in the online retail platform industry, particularly in China. It's also, a sector that is grappling with a consumer downturn as well, people not spending as much as they used to, and an increased scrutiny from the regulatory agencies in China as well. So really not great news. When you look at what analysts are saying, shares are down slightly in pre-market trading for the ADRs, and analysts are saying, this shift into spending more, is eventually potentially going to be a good thing. one analyst was saying that, perhaps this is an indication or a signal that they are looking at a bit more of an AI transformation as well. That is yet to be determined at this point, but surely a lot of companies are talking about that and looking at that and trying to spend more on AI in order to make their companies more efficient and productive. So that is a possibility. But at this moment, the reaction generally is a little bit more negative on the earnings results and where the company is going to spend money.
And of course, the markets being the markets, they love to make liars of us. They're up about 4% now, so they've already taken a flip. It's incredible how volatile the markets are this last little while. And one other one, Divya, ARM. It's selling chips to Meta. It's got a first customer.
Yeah, great news. It announced at an event in San Francisco yesterday that it will be starting to sell its own chips. Meta will be its anchor buyer. Overall, when you look at ARM shares and the way they're trading, at least the last I checked, it was up about 10% or 15% in pre-market trading. So really good news. The fact that it is going to sell its own chips clearly means that it could potentially take away market share from the likes of NVIDIA, which is also good news for the company. One analyst did point to the fact that, the supply chain risk there is still quite heightened at this point in terms of what it needs to build these chips. So that might be a cause for concern. However, there is another analyst that has upgraded the stock, saying this news was the biggest piece of news that could have come out from that San Francisco event for ARM as well. So good news right now, at least. We will have to see how this all pans out in terms of supply chain and whether it has everything it needs to build these chips. But right now, having a juggernaut like Meta as your anchor buyers is a good thing.
Yeah, it's pretty optimistic. $15 billion in sales annually within 5 years. So they think they can do it.
Exactly. I mean, it could, just if you think about the industry as a whole and which company really sells most of the chips, if they can claw back and pull a little bit more from the behemoth in the industry, it could be really, really good for ARM.
Awesome. Divya, thank you very much for joining us as always. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including AG Growth. All right, let's take a look at some of the notable analyst calls and recommendations that we are looking at right now. I'm just going to pull them up on the computer for 1 second here. And let's bring them up. General Motors is up in pre-market trading. Wolf Research analyst Emmanuel Rosner raising the recommendation on GM to outperform from peer perform, writing that investors may be underestimating several tailwinds, including a lower net tariff burden and further improved EV losses. The price target is set to $96. Intron Health has upgraded Roche to buy, noting the recent sell-off in the Swiss pharmaceutical now seems overdone, while upcoming catalysts can drive a revisiting of the investment case. PT maintained at CHF 350. Stock now has 14 buys, 9 holds, 4 sells among analysts tracked by Bloomberg. And National Bank financial analyst Maxim Sichev cut the recommendation on AG Growth International to sector perform from outperform. AG Growth reported earnings that trailed and sales that topped estimates for the quarter on March 24th. PT set to 24 Canadian, implying a 4.6% decrease from the last price. And for more on this, let's bring in Colin Stewart, CEO and Portfolio Manager at JC Clark. Let's talk a little bit about AG Growth and your thoughts on their earnings.
Yeah, it's been a troubled situation for a while. There's been management turnover, some changes at the board level, and I think people were hopeful after the last misstep late last year that the company, the stock had sort of rallied into this year and on sort of hopes that things were on the right track. I mean, they're an agricultural equipment business, and they have struggled certainly with farmer incomes have been weak. That's inflationary pressures on metals, things like that have caused some cost pressure in parts of their business. And it is an international company. They have a big business in Brazil and a growing business in India. But I think a lot of things that people were optimistic about, but again, They reported late yesterday, and the results look again weak. They cut their dividend, I believe, completely, which is something that the market will likely not like. And the results were fairly significantly below analyst expectations. So I would expect the stock will likely be weak again here today.
Yeah, they cut 15 cents per share. They cut it effective immediately, and their outlook, farm segment remains exposed to ongoing cyclical market conditions, and that limits near-term visibility. And commercial segment order intake softened in late 25 and early 26 amid longer customer review cycles.
And they have a fair bit of financial leverage or debt on the balance sheet too, so I think that's a concern. Anytime you have a company with a lot of debt that has weaker results, I think that concern that the debt's going to go up more because the cash flow is weaker, and I think that's what we're seeing here with that growth as well.
Okay. Lots more when we come back. Colin Stewart is with us. He's the CEO, portfolio manager at JC Clark, and he's going to take your questions on First Call. All right, time for First Call. First email, and that one is from Mike. Would like to get your guest view on BN, Brookfield Core. Thank you.
Yeah, it's a company we know fairly well. We've owned it over time, and it's a very, I think, high-quality Canadian business. They, as many know, Brookfield split their business a few years ago to separate sort of the Brookfield Corp, which owns the hard assets, and then Brookfield Asset Management, which is the asset management business. So Brookfield Corp's been weak recently. There've been some pressure on these, sort of alternative investment firms, and I think it's sort of fallen victim to that. Even though I don't think they've, perhaps have the issues that some of these other private asset firms have, and the assets that if you add up the value of the underlying assets that Brookfield Corp would own, the real estate portfolio with very high quality office buildings and malls, their infrastructure business, road, bridges, toll roads, things like that, and then the renewable assets that they own, that would add up to a lot more than where the stock price is trading. So it trades at a nice discount to that net asset value. And I think after this pullback, it's probably not a bad time to look at buying Brookfield. And they're obviously active as we saw this morning with
Boralex. Where do you see that fitting in with them?
Yeah, I mean, it looks like, as you mentioned, Roger, that it was the Brookfield Asset Management that acquired it. But often when Brookfield does these types of deals, I'd have to look at the details more. They sort of hive off pieces of the business. In other words, they have their own renewable, publicly traded firm, Brookfield Renewable, which we actually own, and it could take a piece of it. The asset management business could take a piece. They have private funds with pension funds and sovereign wealth funds that are invested with them. So those funds will likely take a piece of it, and often they split it across different sections of their business. But obviously, renewables have been an area that Brookfield has been very keen on for a number of years, and prices of renewable stocks have corrected recently in the last few years, partly because of things that Trump has been saying about them. And I think that's not surprising to see them make an acquisition here.
All right, let's head to our next email, and this says, Mr. Stewart. The first call, it's from Jimmy. Jimmy Stewart, no, Mr. Stewart. The first call audience seems to have a perseveration for credit risk in the general market. That is a big word for this time of the day. Is Propel Holdings a wonderful possibility for big gains with this crack in economic K-wave theory?
Yeah, I know a little bit about Propel. We've met them before, and I think it's viewed as a high quality alternative lender. They've got a technology sort of based lending platform or online lending platform that is primarily making small loans to consumers and small businesses in the U.S. And the stock has come under pressure recently. I mean, not surprising with the market weakness. There's also been, I think it's been partially down, perhaps in sympathy with Go Easy here in Canada, which is another lender that's come under a lot of stress recently. So I think Propel, when that news with Go Easy came out, was down in sympathy. It does trade. It's been growing quite quickly and trades now, I think, at a very low sort of PE multiple. I haven't checked the most recent stat, but probably 6-7 times earnings. So there are, I think, risks anytime one invests in one of these alternative lenders. And obviously, if the economy were to go into a huge recession or something like that, loan losses could go up. So, you really have to do your homework when looking at a business like this. But we've been impressed by the management and think it's a pretty well-run business.
All right. And I love a new word. I had to look it up. Perseveration is defined as the repetition of a thought, behavior, or response.
There we go.
Great word. Okay. This next email is from Al. Jimmy, thank you for that. Can I get your guest thoughts on Kraken Robotics' current and future outlook?
Yeah, Kraken's a company that we've owned. On and off over the last while. It's sort of participating in this defense theme, and what they do is they have technology that sort of goes on these underwater drones or submarines and can, monitor things, monitor the situation for militaries and commercial applications. And it's, been a real Canadian success story. The company kind of came from nothing a few years ago. As we see, the stock was sort of, sub $2 or $3 only a year ago, and it's had a huge run here. I mean, part of that is they've won a number of new contracts, and they've got a relationship with a company in the U.S. called Anduril, which is a really one of these like advanced tech companies that is, producing technology and submarine solutions for the U.S. military and other militaries around the world. And Kraken supplies their product to Anduril, so that's been a benefit for them. It's been a really good growth story. It trades at a high valuation multiple, so buyer beware. But I think, as part of this whole, bullish trade on military defense stocks in Canada and the U.S., and it's one of the sort of up and coming defense tech companies in Canada. And I think for that reason, it's had a good run here.
All right, we're going to sneak in one more. This email from Michael about Dollarama yesterday. Did I do the right thing? Thanks.
Yeah, I don't think you can go too wrong with Dollarama. And if you go back in history, anytime the stock has been a bit weak off earnings and you've bought that stock, it's been a good decision. It's been a great success story here in Canada. It's the leading dollar store franchise in Canada. They've had growth in outside of Canada and Australia more recently, and people were disappointed with the same store sales numbers and the results yesterday, but I think it does trade at a high multiple, but a very high quality business.
Okay, we'll leave it on that note there. Colin, thanks as always for joining us. Appreciate it. And that is it for us here on The Street. Thanks to Colin Stewart, CEO and Portfolio Manager at JC Clark, for joining us today. Lindsay Biscaya is up next with the Open, and trading gets underway in a little more than 30 minutes from now. Have yourself a great day.